Okay, so now what we will do is that we will start discussing one by one each and every aspect of the various stages of the audit. So the first step that I'm actually going to start discussing will be about the planning stage of the audit. So what does the planning stage of the audit involves? When we talk about the planning stage of the planning stage of the audit involves setting the overall audit strategy, establishing the direction of the audit, and the third one of them is planning out the timings of the various procedures. That's the first thing that is involved in the audit planning. And these are the things are actually covered by ISA 300. Now, so how do we plan for the audit? Let's try to start discussing about this. Remember, when you are appointed as an auditor, the first thing that you need to do is you need to plan out that how exactly would you be conducting this audit. And for you to conduct this audit, there are various factors that are important, which is number one, the staffing is very important. Why is the staffing very important? Because depending upon whether the client is a new client, depending upon whether it's a complex nature client, depending upon whether it's a specialized client, you'll have to plan out your staff accordingly. Also, depending upon the size of the client, you'll have to plan that how much workforce needs to be deployed also. So the staffing needs should be addressed initially, which is that what is the expertise of the staff that would be needed, the number of the staff that would be needed, and at the same time the experts, if they would be needed or not. Because at times, if you're going for, let's say, performing an audit of a petroleum company and oil and gas exploration company, so you may be needing the services of the experts. Why? Because the expert is going to help you decide whether what levels of inventory are held by this oil company, what levels of inventory of gas is available, what levels of inventory of oil is available. The expert is going to help you decide. So you need to decide that what is going to be the staffing needs. Similarly, the overall direction of the audit. What are the areas that you would be tackling first? What are the areas that you would be tackling at a later stage? So this is generally the overall direction of the audit is what you need to decide also. The third thing is the timing. The timing of the key procedures. Because when we go for the audit, there are various key procedures which the auditor has to perform on his own. And what are those key procedures? Like, for example, cash count, for example, inventory count, for example, receivable circularizations. So these are the various things which you as an auditor have to plan out in advance, that when exactly are you going to be conducting these things. So if I talk about the planning stage of the audit, the planning stage initially involves setting out the audit strategy, setting out the direction, establishing the timings of the various procedures that you will be performing. Now, let's move a bit forward. So that's one aspect of the planning. Now, what else does the planning involve? So the planning stage of the audit also involves the application of ISA 315. Now, what is this ISA 315 application? So ISA 315 actually covers up various things, which is understanding of entity, its environment, and assessing risk of material mischief. So when I talk about ISA 315, ISA 315 is part of the planning stage of the audit, where you actually decide, where you actually obtain understanding of entity, you obtain understanding of the environment of the entity, and you assess the risk of material mischief. Now let's try to understand each one of them one by one. When I talk about obtaining understanding of the entity, so what exactly do I mean? So as an auditor, if there is a new entity which you are going to, So you need to understand the entire business of that entity, that what business does it conduct, what is its overall operational cycle, who are its suppliers, who are its customers, who are its competitors, what are the recent development that are taking place with respect to its company's environment. Furthermore, you should actually know that what are the business locations. You should know any changes that have arisen during the current year with respect to this company. Any further developments with respect to the company's overall structure. Now, what could be the developments with respect to the company's structure? The developments with respect to the company's structure could be that maybe new subsidiary is being undertaken, maybe an existing subsidiary is disposed of. So when we talk about understanding of the entity and its environment, so understanding of the entity and its environment would actually means understanding the entire business of the company, understanding how its business cycle operates, understanding who are its key customer, understanding who are its suppliers, understanding what is the competitive environment, getting to know the locations that the company is situated at, getting to know the changes that have arisen with respect to the entity's business during the current year, the latest developments that have taken place with respect to the company, the new products launched, the products launched which failed, the legal cases that have been filed with respect to the company, etc., etc. So the various things that you should know as an auditor which have actually taken place, which have actually arisen with the company, so you should know them. So when we talk about the planning stage, the understanding of the entity and its environment is one of the key factors. The next step is assessing the risk of material misstatement. The next step is assessing the risk of material misstatement. Now, if I talk about assessing the risk of material misstatement, so what exactly do you mean by assessing the risk of material misstatement? Let's try to understand this, that what exactly do you mean by assessing the risk of material misstatement? So when I talk about the risk of material misstatement, so risk of material misstatement actually means the risk that financial statements will be materially misstated. Now, what do you mean by financial statements to be materially misstated? Let's try to understand that. So when we talk about the financial statements to be misstated, so the misstatement is actually on the basis of two things. When we talk about the misstatements are actually on the basis of two things. Now, what exactly are these two things with respect to the misstatement? One of them is the non-compliance of accounting standard. The other one of them is non-validity of assertion. So at the planning stage of the audit, you need to assess the risk of material misstatement also. Now what exactly do you mean by assessing the risk of material misstatement? So I'm going to explain to you that what exactly do you mean by risk of assessing the risk of material misstatement. Now, when we talk about the misstatement could be with respect to two things. Now what are the two things with respect to which the misstatement could arise? Number one of them is non-compliance of accounting standard, and number two is non-validity of assertion. When we talk about the non-compliance of accounting standard, the non-compliance of accounting standard would actually mean that when we apply any accounting standard, there are various things that need to be considered with respect to the application of accounting standard. Now, what are those things? So, for every accounting standard, you would have a scope para, you would have the recognition criteria, you would have the measurement criteria, you would have the derecognition criteria, and disclosures. So for every single accounting standard that you apply, generally these are the 5 things that are applicable. So when I talk about the misstatement in the financial statement would mean that you have not complied with the relevant accounting framework. Why? Because the financial statements have to be prepared in accordance with the applicable financial reporting framework. And if you have not followed that financial reporting framework, that means you have not complied with it. Now, how do we not comply with the financial reporting framework? I'll give you various examples. Let's see. The first thing is the scope. Whenever we talk about any accounting standard, so every accounting standard has a scope. Now, what do you mean by accounting standard having a scope? When I talk about accounting standard having a scope, this would actually mean that applicability of the accounting standard. Now, IS 16 property, plant and equipment is applicable on property, plant, equipment. IS 40 is applicable on investment property. Now, there is a very thin line between investment property and property, plant, equipment. How? Let's see. If I have got a land and I have kept the land for administrative purposes, then it's a PPE. If I have a land and I've kept the land for renting out to others or for capital appreciation, then that land would fall under IS 40. If I have a piece of land and that land has been kept for an undefined use, I have not decided what am I going to do with this land. So that land would actually be classified as an investment property and not PPE. So when we talk about the non-compliance of accounting framework, so what do we mean by non-compliance? Non-compliance means that you have made an error with respect to the application of accounting standard. So if there is a piece of land for which an undetermined future use is there, and I classified it as a PPE instead of investment property, then that's a scope violation. And the scope violation would be non-compliance of accounting standard, and that is called a misstatement. Now, what is the second example of the misstatement? Every accounting standard prescribes a recognition criteria. If you want to recognize revenue, you have to follow the criteria under IFRS 15. You want to recognize an asset, you have to follow the criteria laid down under the relevant accounting standard. So when we talk about the recognition criteria, so recognition criteria is laid down in every single accounting standard. And if you do not follow the relevant recognition criteria, that means that's a misstatement. IS 16 says a property, plant, equipment has to be recognized if it is probable that future economic benefits will flow to entity and the cost can be estimated reliably. Now, you are unable to estimate the cost of an asset reliably and still you have recognized that asset. That means that you have violated the recognition criteria. And if you have violated the recognition criteria, that means that that's a non-compliance of accounting standard. And that is ultimately going to be a misstatement. There is an asset which should be initially recognized at cost, but instead of cost, you recognize it at fair value. So that means you have not fulfilled the measurement rule, you have not fulfilled the measurement criteria. That is also non-compliance of accounting framework. Now, so basically when we talk about it, so scope, recognition, measurement, derecognition, disclosure, if there is any minor non-compliance, that is called misstatement. So as an auditor at the planning stage, you need to assess the risk of material misstatement. What do you mean by misstatement? So I mentioned that it's non-compliance of accounting framework. That's one of the ways of misstatement. Now what else is there? So the misstatement also means non-validity of assertion. Now what exactly is an assertion? What exactly do you mean by assertion? Let's try to understand the concept of assertion. So assertion actually means the deemed claims made by management while preparing financial statement. So the claims that the management makes while preparing the financial statement are actually termed as assertions. What do you mean by assertions? So assertion actually means the claims which the management makes while preparing the financial statement. Now what are the various assertions? So if you have to remember the assertions, I would suggest remember this mnemonic which is called C square compare. Now what do I mean by C square compare? What is this mnemonic? What does this mnemonic stand for? So let's try to understand. So when I talk about the C square compare, the C square compare would actually be referred to as cutoff, completeness, classification, occurrence, measurement, presentation and disclosure, accuracy, rights and obligation, and existence. So when we talk about the assertions, so the assertions are actually like this. The C square compare stands for the cutoff, completeness, classification, occurrence, measurement, presentation and disclosure, accuracy, rights and obligation. Now we would discuss that what exactly this cutoff means, what is completeness, etc., etc. Okay, so let's just start discussing about the various assertions. Now, when I talk about these assertions, the first one of them is the cutoff. So basically these assertions means that when the management is preparing the financial statements, it is claiming that it has complied with C square compare. It is claiming that it has complied with C square compare. Now what do you mean by this? This actually means that first of all, management is claiming that we have ensured that the cutoff procedures are appropriate. Means the transactions have been recorded in the correct period. The sales for 2019 is recorded in 19, sales for 2020 is recorded in 2020. That's what the management is claiming. Second thing is about completeness. And what is the management claiming? Management says that they've ensured every single asset, every single liability, every single item of income, every single item of expense is recognized. Then there is this classification. Now what do you mean by classification? So the classification is that the management is claiming that we have appropriately classified all the items. Now what do you mean by appropriate classification? So appropriate classification would mean that if there is something which is an investment property, we've classified that as an investment property. If there is something which is PPE, so we've classified it as a property, plant, equipment only. That's what the management is claiming. The next is occurrence. You see what happens is, at times there are fictitious, there are bogus, there are dummy transactions that take place in the organization. You may book sales, but you have not actually sold. You may record expenses, but there have been no expenses incurred. So the occurrence actually refers to that the management is claiming that if we have reflected any transactions in the financials, then that transaction has actually taken place. Next is the measurement. Measurement actually means that the requirements of the relevant accounting standards have been followed while measuring an item, whether that pertains to initial recognition, whether that pertains to subsequent recognition, but the requirements of the relevant accounting framework have been followed. The presentation and the disclosure. Now what do I mean by this, the presentation and disclosure? This actually refers to that when the financial statements have been prepared, the financial statements have shown the items in an appropriate manner, the way that they should have been shown. The way the sales, the way the P&L should have been prepared, which is the sales less the cost of sale, it's been done exactly the same way. That's what they mean to say when it comes to presentation. And when it comes to disclosure, so it's about the notes to the financial statement are in accordance with the relevant accounting framework. The accuracy. Now, what do you mean by accuracy? Accuracy is that there could be various errors that could be incurred while preparing the financial statement. It could be error of omission, it could be error of commission, there could be an error of transposition, there could be various types of error. So what the management is saying is that it says the management is claiming that whatever the amounts that have been shown, they've been shown correctly. Whatever the values that have been shown, they've been shown correctly. If there are any calculations like depreciation or etc. that we have performed, they're all being done in a proper manner. That's what the management is claiming. Rights and obligations. The assets that we have shown as our assets, we actually do have a right on them. It's not necessary we own them, because at times when you've got leased assets, you don't own them always. When you've got leased assets, you don't ultimately own them. But you have the right to use, and you can record them as an asset in your financial statement. So when it says rights and obligations, so it's actually the assets that we have shown as our own assets. We have a right to use those assets. We have an ownership of those assets. That's what you mean to say. And then it comes to the obligations. So the obligations that we have shown in the financial, we are actually obliged to them. We actually do owe them. We actually do have to pay to those people. And lastly, the existence, that the items that we have shown probably about the assets, they do exist. So when the management prepares the financial, it's a deemed assumption that the management has complied with all of these, which is C square compare. It's a deemed assumption that the management has complied with all of them, which is C square compare. So at the planning stage, what you need to do is that you need to evaluate, you need to assess the risk of material misstatement. And what do I mean by misstatement? This is non-compliance of accounting framework or the non-validity of assertion. Now, important thing is, what exactly do you mean by materiality or the material transaction? So remember, materiality percentages have not been defined in ACCA. Materiality percentages are mentioned in books, but they have not been defined by ACCA. So where do these materiality percentages they come from? They're from the practical application. So materiality is of two types. One of them is quantitative and the other one of them is called a qualitative materiality. So the materiality is of two types. One of them is quantitative, the other one of them is a qualitative materiality. Now let's talk about it. What's a quantitative materiality? What's a qualitative materiality? So when I talk about the quantitative materiality, so the quantitative materiality would mean that you've got PBT, 5% of the PBT is considered to be material. 2% of total assets is considered to be material. 1% of the total sales is considered to be material. So when I talk about the materiality, so the quantitative materiality is, these are the quantitative thresholds that are given, which is 5% of the profit before tax, 2% of the assets, 1% of the sale. This is how the materiality are established. Or at times there are transactions which are qualitatively material. Now what do you mean by transactions being qualitatively material? Let's understand. The transactions being qualitatively material would mean that the nature of the transaction is such that it becomes a material item. Like for example, a related party transaction is a material transaction because a related party transaction is susceptible to misstatement. Related party transaction could be manipulated. So from the audit perspective, it's a material transaction. So I'm repeating it again. From the audit perspective, it's a material transaction. Similarly, a company has been assigned a loan and the party who has given the loan has set a covenant. What is that covenant? It's a debt covenant that they have actually given, which pertains to the current ratio. Now, if there is a covenant pertaining to the current ratio, I'm repeating it again. So that means the value of the current asset, the value of the current liability would be susceptible to misstatement. The value of the current asset, the value of the current liability would be susceptible to misstatement. So that means the current asset items, the current liability item become a material item. So anyways, when we come to the assessment of the risk of material misstatement, so you need to see that the risk of material misstatement is the risk that financials will be materially misstated. How? The materiality is quantitative or qualitative. And misstatement is either non-compliance of a standard or non-validity of assertion. So anyways, I hope that it is actually clear till here that what does this planning involve, which involves the understanding of entity, its environment, and then the assessment of the risk of material mistake. So that is a general overview of what we do at the planning stage of the audit.